Our lecture series on managerial accounting. I'm your instructor Jamal Haider. Today we will talk about chapter 6 from your book, Cost Volume Profit Relationship. The other name of this one is called CVP analysis. So here C for cost, V for volume, P for profit. So why we are including this cost volume profit analysis in our managerial accounting? Because CVP analysis helps managers understand the interrelationship among cost, volume, profit by focusing their attention on the interaction among the price of the product, volume of the activity, per unit variable cost, total fixed cost, and mix of the product sold. So basically it is a vital tool used in many decisions of the business, such as deciding what products to manufacture or sell, what pricing policy to follow, what marketing strategy to employ, and what type of productive facilities to acquire, right? So that was the introduction. So let's begin our learning objective 1. That is, explain how changes in activity affect contribution margin and net operating income. So just going to give you a little idea about contribution margin. The formula of the contribution margin, our contribution margin income statement format is, we have a sales with less variable cost, we get contribution margin, and if we less fixed cost from the contribution margin, then we get net operating income. We can also derive our definition of contribution margin, that is, after covering fixed cost, right, sale minus variable cost, so that contribution margin directly goes to net operating income. So remember here, this is net operating income, not net income, because from the net operating income we less interest and other expenses as well, and then we get net income. So we just talking about net operating income. Okay, so if you don't understand this concept here, if you cannot digest right now, don't worry about it. In the next coming slides we're going to talk about extensively. Okay, so let's move to the next slide. Basics of cost volume profit analysis. So the contribution margin format, here we have sales less variable expense is equal to contribution margin, and from contribution margin we less fixed income, and we get what? Net operating income. So this format basically help managers in judging the impact on the profit, of changing in selling price with respect to selling price, variable cost, and fixed cost, or the volume as well, right? So in order to understand the cost volume profit analysis, we have a hypothetical example of a company name as Racing Bicycle Company, or we call it RBC. So throughout the slides we're going to call it racing or RBC. So we're going to talk about its application regarding to the cost behavior. Okay, so contribution margin is the amount remaining from sales after variable expenses have been deducted. Simple, sales minus variable cost, the amount left is called contribution margin, right? So if you notice the example here, the focus here is the cost behavior, right? So variable costs are separated from fixed cost as well. Variable cost is separate, fixed cost is separate. So let's go to further explore this example. So the other definition of cost volume profit analysis, in which we just discussed about that, if you don't understand that example over there, don't worry about that. We're going to talk about extensively in our coming slides. Here it is. So we talk about contribution margin is used to first cover the fixed expenses. So any remaining contribution margin contributes to the net operating income, right? So you have contribution margin 100,000 and fixed cost is 80,000. If our contribution margin also 80,000, then whatever left goes to our net operating income, which is 0, right? If our contribution margin is 120,000, right? So whatever amount left after covering fixed cost, how much? 40,000, then 40,000 will directly goes to net operating income. So that is the other definition of contribution margin. So I hope you understand that. If you don't understand that, then let's talk about on our weekly live tutorial lecture, or just write us on our Blackboard and our WeChat group, which is Managerial Accounting CIP 2020. Okay. So here, the contribution approach. So we are formally beginning our analysis. So let's talk about this, that we can also convert our contribution margin income statement into per unit basis as well. So here, sales variable expense and contribution margin can also be expressed as per unit basis. So here, if racing sells an additional bicycle, right, 200 additional CM or contribution margin will be generated to cover fixed expenses and the profit. So basically they are talking about we can also convert our sales into per unit sales as well. So we know that total sales 250,000. So how many units are sold? You can easily find out that 500 bicycle. So where this 500 per unit cost of the per unit sale come from? We have 250,000 divided by 500 bicycles. Answer is 500. Where this 300 came from? We have total variable cost, which is 150,000, and how many we have produced bicycle here? 500. The answer is 300. We can also find out this as well. How many in dollar figures we have contribution margin? 100,000, right? And how many units are produced? 500 divided by 500. Answer is 200. Or we can find out that sales minus variable cost also reveals this 200. So you can find out one or the other way, right? So we can also express our contribution margin, sales and variable cost as per unit as well. Okay, so in this